This is a presentation on 2023 federal tax law changes. Federal tax law changes information can be found in IRS publication 4491, the VITA TCE Training Guide. In a section called Important Changes for 2023, it's Roman numeral number 9. The 2023 tax filing season is probably most notable for what's missing. After years of stimulus payments and pandemic tax breaks, nearly all those extra benefits have faded away, and tax refunds are likely to shrink as a result. So basically returning to normal, if there is a normal. So in this presentation, we'll cover major tax changes for 2023. There aren't a lot of them. We'll also cover some other tax changes. So we'll be looking at tax bracket thresholds that widened, the standard deduction that increased, refundable child tax credit that increased to $1,600. We'll look at a couple of examples. Premium tax credit that's been extended through 2025. New exceptions to the 10% early distribution penalty. The 1099-K reporting, there'll be no change in 2023, but the IRS has announced that the threshold will be reduced to $5,000 for 2024. We'll look at the EITC, investment income limit increased to $11,000. That's the Earned Income Tax Credit. The updated Energy Efficient Home Improvement Credit, probably the major change this year. And business meals deduction reduced to 50%. The IRS adjusted the standard deduction in response to the high inflation we've been experiencing in the last few years in an attempt to safeguard taxpayers against the growing cost of living. As you can see, here are the standard deductions for 2023 and for 2022. Notice a single taxpayer now has a standard deduction that's almost $1,000 higher, went from $12,950 to $13,850. And you can see the corresponding increases for head of household, married filing jointly and surviving spouse, and married filing separately. Below are the additional standard deductions that are added for blindness or age 65 and up. For 65 plus or blind, single or head of household, it's now gone from $1,750 to $1,850. The 65 and blind went from $3,500 to $3,700. And we can see that the 65 plus or blind married filing jointly or separately increased by $100, and 65 and blind married filing jointly or separately increased from $2,800 to $3,000. What's amazing to me is that this year to think that a married couple filing jointly, their standard deduction, if they're both 65 years old, will be over $30,000. Tax brackets. There was a big adjustment of the federal income tax brackets. While the rates didn't change, there's roughly a 7% increase in the brackets, which expanded the amount of taxable income you can have in each tier. So generally, wider tax bracket thresholds will reduce tax liability for most taxpayers. However, the most pronounced impact will be felt by those in the higher 22% through 37% brackets. So these adjustments may not lead to an increased refund for taxpayers, as their withholding rate would have been reduced along with their reduced tax liability. Now, looking ahead, the IRS has already released adjustments for 2024 tax year, factoring an estimated inflation rate of 5.4%, in case you're interested. Just a comment on inflation adjustments. In October 2022, the IRS announced tax inflation adjustments for 2023 tax returns impacting over 60 tax provisions. I'm not going to cover them in this presentation, but just to show you, there are a lot of different tax provisions that were impacted by the high rate of inflation we're experiencing and we have been experiencing. I'm only covering, again, the major ones in this presentation. I can still remember my supervisor back in 1981 who had a home mortgage of 18.5%. So if we just look at a single tax filer here, 2022 rate, sorry, at the bottom, 10% rate, it's 10% on 0 to the first 10,275. You can see that's been raised in terms of the upper limit to $11,000 and corresponding across the board. So I thought it'd be interesting to take a look at long-term capital gains rates since we'll be encountering taxpayers who will have those during the year, most likely, and found it interesting to look at a single in terms of a 0% rate, meaning if their taxable income, I'm looking at 2022 now, was under $41,675, they paid no tax on their long-term capital gains. That 41% or $41,675 increased in 2023 for a single taxpayer to $44,625, almost a $3,000 increase. You can see the 15% rate where the bottom is moved up from 41,000 to 44,000, but the top end moved from 459,000 to 492. And at the 20% rate, it's increased from over 459,000 for a single to over 492,300 for a single in 2023. We can see here the contribution limits for traditional and Roth IRAs in 2022 at the top and 2023 at the bottom. So the standard limit in 2022 was $6,000 for both traditional and Roth. The catch-up limit, age 50 or older, was an additional $1,000. So someone 50 or older could have contributed $7,000. In 2023, the standard limit increased by $500 for both traditional and Roth. The catch-up limit did not increase. So the overall, if you were 50 or older, your limit was $7,500 for both the traditional and Roth in 2023. Now, the modified adjusted gross income limits where you can contribute to these did increase. So as an example, for single taxpayer, it went from and phased out between 129,000 and 144,000. And for a single in 2023, a single taxpayer, it phased out from 138,000 to 153,000. Required minimum distribution age. The age for beginning required minimum distributions, or RMDs, from defined contribution plan or from traditional IRA increased to 73 from 72 during the year 2023. Taxpayers born in 1951 must receive their first required minimum distribution by April 1, 2025. Rule is you have till the next April 1st to take your first distribution after you turn 73. Now, this isn't financial advice, but people should be aware that waiting until the next year to collect their first required minimum distribution will require taking 2 required minimum distributions that year. So, for example, someone who turns 73 on October 1st in 2024 could wait until April 1st of 2025 to take their first distribution. Now, that would satisfy the requirement for 2024, but they'd also need to take their 2025 distribution, minimum distribution, during 2025. So that'd mean taking 2 required minimum distributions the same year. And that could really cause issues when filing taxes for 2025. Okay, next we're going to look at the child tax credit. So here are the requirements for the child tax credit. It's a non-refundable credit. The child must be under 17 on the last day of the year, 12/31. Must be a U.S. citizen, U.S. national, or resident alien. Child must be claimed as a dependent. They can't provide over half of their support. You have to have lived with the taxpayer for more than half the year. And the child must have a Social Security number that's valid for employment. The child tax credit's worth up to $2,000 per qualifying child in 2023, which hasn't changed since 2022. It's not fully refundable, which means you can't receive the entire $2,000 back as a tax refund if you have 0 tax liability and qualify for the full credit amount. It only reduces the amount of tax you owe. Now, the child tax credit is generally a non-refundable credit if the tax liability is less than the child tax credit, the remainder becomes a refundable credit. And this portion is called the additional child tax credit. And it cannot exceed $1,600 per qualifying child. Excuse me, it was $1,500 in 2022. So there's the increase this year. Note, keep in mind that not everyone can receive the full amount of the 2023 child tax credit. That means it's possible to receive a tax refund lower than $1,600 even if you don't owe any tax. That's because $2,000 per child is the maximum amount of credit, and $1,600 per child is the maximum amount of the refundable portion. I'm going to show, I know it's a lot of words, I'm going to show two examples that I hope will explain how this works. So the additional child tax credit, taxpayers more than $2,500 of taxable earned income may be eligible for the additional child tax credit if they have at least one qualifying child. Taxpayers with 3 or more children may also be eligible for additional child tax credit regardless of their income. It's limited to $1,600 per qualifying child. So let's take a look at an example. We're going to start off with the child tax credit. We have a family who has 2 children. They have 2 children under the age of 17. The taxable income is $26,376. There are no other credits or taxes or penalties. The 2 children times the $2,000 child tax credit is $4,000. The income tax they have on line 16 on the Form 1040 is $526. They owe $526. That's their tax liability. Now the child tax credit can't be more than the tax liability, which is $526. So the total tax is they have their $526 tax liability, what they owe, and they use $526 of their child tax credit against that, and the result is they owe 0 tax. Now that's the non-refundable portion. Look at the box in the lower left. There's their $4,000 child tax credit. They used $526 of that. They still have $3,474 of the child tax credit left, but they can't use it because the child tax credit can only be applied against tax liability, what they owe. And they've done away with that already. Well, the maximum additional child tax credit allowed for this taxpayer is $1,600 times 2 children. They are entitled to $3,200 of that. So only $3,200 will get added to the return as a refundable credit. That's what they'll get back. Now the difference between the two, $3,200 and $3,474, is what they weren't able to take advantage of. So there's $274 that's left on the table, if you will. We're going to look at another example. So here's our second example. Family with 2 children, they're under the age of 13. Assume that no other credits or taxes or penalties. The 2 children times $2,000 for the child tax credit is $4,000. Income tax on line 14 from Form 1040 is $3,256. Now, the child tax credit can't be more than a tax, so they can use $3,256 to offset their tax liability, what they owe. So the total tax is $3,256 minus $3,256. That's their child tax credit, and so they owe nothing. That's their non-refundable portion. Now, they had $4,000 child tax credit. They used $3,256 for taxes. So the $744 is the amount of the child tax credit left to be added as a refundable credit. So assuming they qualify for that $744, remember they could get up to $1,600 per child, they will use the entire $4,000 child tax credit, the original credit they had. So the difference is that in example 1, they were able to use, if you will, $3,726. In example 2, they were able to use the entire child tax credit of $4,000. Again, combining the child tax credit as an offset against tax liability, and then using the additional child tax credit. I hope that explained it. Now I want to look at another credit, the premium tax credit. Under the Affordable Care Act, the government set up subsidies to help people pay their health care premiums, which they obtain through what are called marketplaces. In Massachusetts, the health insurance marketplace is called the Mass Health Connector. You'll be hearing about that, and you're seeing that quite a bit during tax season, most likely. Now, premium tax credits, the subsidies I just mentioned, can reduce the healthcare costs for marketplace policies. The amount of the premium tax credit that people receive depends on their income and the cost of marketplace health plans in their area. So the marketplace determines the expected contributions people are required to pay towards the premium for a mid-range, what's called silver benchmark plan. Now the plans in the marketplaces can be bronze, silver, gold, and platinum. They just set it at the silver level. The expected personal contribution increases based on income and the higher level of plan that's chosen. Now, the government has a measure called the Federal Poverty Level, or FPL, which is shown in the chart on this slide. The FPL is the minimum income that a person or family requires for food, clothing, transportation, shelter, and other necessities. You can see that a single person in 2023, according to the government, that's under the 100% column on the left, would need $14,580 to cover basic necessities. For a family of four, look down the column below that, 100% federal poverty level would be $30,000. So why am I going through this discussion? Well, the government uses the federal poverty level to determine who qualifies for the premium tax credit that we're talking about and how much credit they receive. If income is between 100% federal poverty level and 150% of the federal poverty level, the expected contribution people are required to pay toward the benchmark plan is zero. They pay nothing. So if I was single and earning $20,000 and I chose the benchmark plan, you can see that for me it would be between 133% and 138% is where 20,000 would be. I wouldn't pay anything for my plan as long as it was that benchmark plan. Now over on the right, way over, once income reaches 400% of the poverty level, that's the federal poverty level, the expected contribution taxpayers are required to pay toward the benchmark plan is 8.5% or 8.5% of their income. Now the difference between the premium for the benchmark plan and a person's expected contribution equals the amount of their premium tax credit. So premium tax credits can be claimed at the end of the year, or people can apply for what's called an advanced premium or advanced premium tax credit based on their estimated income for the upcoming year. So if someone elects to receive an advanced credit, the government pays some of the credit directly to the insurance company each month, and the insurer will bill the rest of the premium to the policyholder. So I go to the marketplace here in Massachusetts, the Mass Health Connector, and I tell them that, hey, this is how much money I'm earning, or I expect to earn next year, let's say. And for that next year, they base then how much I am entitled to or not in terms of the premium tax credit. And potentially then they could start paying that money, this is the government, directly to my insurer on a monthly basis. Now, if they were doing that during the year, that's what we call an advance premium tax credit. Now, what happens if I lose my job? If I lose my job during the year, I'm not going to earn as much income as I reported before the year started to the connector, Mass Health Connector, and I might be entitled to additional premium tax credits. I could get more potentially because my income's not going to be as high. The reverse could happen. I could hit the lottery. I could get a big promotion, get a big raise in pay. And now I'm earning more than I expected. And now I should understand I'm probably not entitled to as much of a premium tax credit based on income as I thought I would be entitled to. So one of the things that people need to do is to inform the Health Connector folks that, hey, something changed in my salary, let them know right away. Now, what happens though if I'm getting more than I'm really entitled to? Well, during tax season, that gets reconciled. And what we're looking at here is repayment amounts based on the federal poverty level. So if someone is, just to use an example, if I were using the example before, making $20,000 a year and my federal poverty level was about 133%, let's say, looking at the first column, I would be under 200%, which it says under 200%. So it shows filing as single in the middle column, and I would be single, then the maximum I would have to pay back because of my income level is $350. Taxpayers with other filing statuses, the maximum, if they're under 200% of the federal poverty level, would be $700. You can see the other columns and so forth. Someone between 300%, let's say 200% to 299%, they would pay back $900. Notice the bottom, 400% or more. That was that column way over on the right in terms of income. So I'm filing as single. If I go over 400%, I have to pay it all back, whatever they paid me extra that I wasn't entitled to. Same thing, taxpayers using other filing statuses. They have to pay it all back. They would have to pay it all back if they went over 400%. Now, one of the things that they changed, and we're going to show on the next slide, and that can be a tremendous amount of money. One of the things we're going to see on the next slide is that they did put in a minor change to that. So I put the asterisks in here to say they may not have to pay it back if the premiums are over 8.5% of income. We're going to take a look at that on the next slide. Fine. So what's going on with the premium tax credit in 2023? Well, due to the pandemic, for tax years 2021 and 2022, the American Rescue Plan Act of 2021 expanded eligibility for the premium tax credit by eliminating a rule. There was a rule that a taxpayer with household income above 400% of the federal poverty level couldn't qualify for the premium tax credit. So that was removed. Now they could. Well, that was going to end this year, but the government decided they'd modify the change. So for 2023, households with incomes over 400% of the federal poverty level may still qualify for the premium tax credit, and it extends into 2020 all the way to 2025. So as you can see in the slide down below in the blue, the cost of the second lowest silver plan, that's the benchmark, is compared to the household's total income to determine eligibility. For premiums under 8.5% of income, no subsidy is allowed. So a family would pay all the premiums and have to pay back all the subsidy they received, all of their premium tax credit, or if it was obviously advanced, they'd pay that back. Premiums over 8.5% of income, some subsidy is allowed. So they may have to pay back some, but not all of it. Now, we talked about calculations on Wednesday a little bit. The software will perform all of the calculations dealing with the premium tax credits. Now, monthly subsidy amounts paid to the insurer each month to offset the cost of premiums are based on, I just talked about this, I want to emphasize this, they're based on projected income for the year ahead. But the true amount of the premium tax credit depends on the actual income in the year a taxpayer is receiving their subsidized health insurance coverage. So if a taxpayer ends up earning more than anticipated, they're going to have to pay back some of the subsidies we've seen and we talked about. Now, this can catch a lot of people off guard, especially since the tax credits are paid directly to the insurance carriers each month, the advanced ones. But if overpaid, they got to be returned by the insured taxpayer. And how does that happen? It happens when they file their taxes. So the tough part, and this is going to try to explain to taxpayers why they owe money back. And sometimes, especially if they didn't ensure their income information that you're supposed to provide to the marketplace was correct and current, they can owe a lot. So this is an area where I've seen the most anguish among taxpayers to see someone that owes $6,000, $7,000 and had no idea they were going to have to pay that or owe that in taxes. So just FYI, last thing I want to mention is you may have noticed, if you were paying attention, no mention was made of people who are under 100% of the federal poverty level. Note that column starts at 100%. That's because if they're under 100%, they should be covered by Medicaid through the state, and in our case, through the state of Massachusetts, which makes them ineligible for premium tax credits. Distributions from retirement accounts like IRAs and 401ks are subject to an early distribution penalty of 10% if the distribution is taken before a taxpayer reaches the age of 59 and a half. That's in addition to the normal tax paid on the amount they receive. Now, prior to 2023, there were a number of exceptions allowed by the IRS. You can find on the IRS website, if you just search IRS exceptions to tax on early distributions, you can find them, but I saved you the trouble, and I've listed them here on this page over on the right-hand side. Now, I could walk through them, all of them, but we're not here to discuss what's already, what already exists. We need to see what's new for 2023. And what is new are listed on the slide. So this year, the exception to the 10% additional tax for early distributions is expanded to include additional distributions made to qualified public safety employees after separation from service on or after December 30th, 2022. Catch, it's not December 31st, it's December 30th of 2022. Distributions to public safety employees separating from service on or after they reach age 50, or those employees with 25 years of service with the plan, whichever is earlier. Next, distributions to firefighters covered by private sector retirement plans who meet the age or years of service requirement in number 1 above. And distributions to those employees who provide services as a corrections officer or as a forensic security employee, providing for the care, custody, and control of forensic patients who meet the age or years of service requirement above as well. Now, distributions to terminally ill individuals, the exception to the 10% additional tax for early distributions is expanded to apply to distributions made to terminally ill individuals on or after, again, December 30th, 2022. Now, the distribution may be repaid within 3 years from the date of distribution. The IRS had planned to require third-party payment organizations like PayPal or Venmo, you might be familiar with, to start issuing 1099-K forms for any payments over $600. But following feedback from taxpayers and tax professionals and the payment processors, the Internal Revenue Service decided to delay the new $600 reporting threshold for tax year 2023. But they're planning to install a threshold of $5,000 or set up a threshold of $5,000 for 2024 to start to phase in the new law. Now, the agency's making 2023 another transition year to implement the new requirements, so the previous reporting thresholds will remain in place for 2023. That means that for 2023, payment apps and online marketplaces are only required to send out Form 1099-Ks to taxpayers who receive over $20,000 and have over 200 transactions. Again, for tax year 2024, the IRS plans for a threshold of $5,000 to phase in the reporting requirements. Taxpayers should be aware that while reporting threshold, while it remains over $20,000 and 200 transactions for 2023, companies can still issue a 1099-K form for any amount. Now, it's important to note that the higher threshold doesn't affect the actual tax law to report income on tax returns, right? So all income, no matter the amount, is taxable unless it's excluded by law, whether a Form 1099-K is sent or not. And now we're going to move on to the Earned Income Tax Credit. Taxpayers who worked or were self-employed and had earned income under $63,398 could receive the Earned Income Tax Credit by filing a tax return. You can see in the chart below that the income restrictions for the Earned Income Tax Credit have increased in 2023. 2022 is below. The first column, by the way, is for all tax filing statuses except married filing jointly, which is shown separately. So taxpayers with earned income and an adjusted gross income of at least $1 are eligible for this credit. Now, married taxpayers who don't file a joint return can claim the EIC only if they had a qualifying child living with them for more than half the year and they either lived apart from their spouse for the last 6 months of the year or they're legally separated. Now, taxpayers must be at least 25 but under 65 as of December 31st. This is one of those credits where eligibility requirements shifted due to the pandemic. So the restriction had been no one over 65, but then a restriction was removed, and then another year it reverted back to 65. So the taxpayers were wondering, what the heck happened? I got this last year. Why didn't I get it again? What are the credit amounts? Well, these are the maximums the taxpayers can receive, which have basically risen due to inflation. Now, by the way, just an aside, there are about 60 items, including credits, that the IRS may increase each year due to inflation. I may have mentioned that earlier. Now, if they're eligible for this credit, the maximum amount you can receive is $600 if you have no dependent children, $3,995 if you have one qualifying child, $6,604 with two qualifying children, and $7,430 with three or more qualifying children. You can see that for like a person with no children, which was added, this didn't exist a few years back, they received $560 in 2022, and in 2023 it was $600, and you can see the others as well. Now, the investment income limitation, so not only earned income, there are other qualifications. One of them was that you couldn't earn in 2022 more than $10,000 in investment income. That's been raised by $1,000 in 2023 to $11,000. So what do we have here? As a way of explaining how the Earned Income Tax Credit works, I want to show this diagram. On the left-hand side, we have the amount of the credit that a taxpayer could potentially receive, and at the bottom of the graph are the AGI and or earned income of the taxpayer. Now, each line that we see on the graph has a different color. 3 or more children is orange. 2 children is in dark blue. 1 child's green is in green. And then no children are sort of in a maroon, I guess. So we also see that some of these lines are solid and some of them are broken. These broken lines are for married filing jointly. The solid lines are for single or head of household. Now, as we look along the bottom leg of the graph, as income increases, the amount of earned income, the earned income credit, also increases till you get to a certain point on the graph, and then everything goes flat for a while, and then it starts going downhill. So the amount of earned income credit that somebody will receive after they pass that, we'll call it a plateau, ends up going down, and eventually taxpayers end up being totally phased out. They don't receive anything. Now you can see that somebody that's married filing jointly that has 3 or more children can potentially receive over $7,000 in earned income tax credit that'll be added to their tax return. So we can see why some people depend very heavily on this credit. We can also see at the bottom where it says no children. Now, that didn't even exist in the past. I think it was a big change to the tax law in 2021. Taxpayers married filing jointly with no children, they could potentially receive $600. Again, that didn't happen a few years ago. Basically, more taxpayers are benefiting from this due to the expanded levels of AGI and earned income. The credit amounts have also increased due to normal inflation. Now, one last comment. Over the past several years, the amount of credit for people with no qualifying children, remember that they didn't get it a few years ago, but the amount of credit they were getting dropped quite a bit. It was dropping quite a bit. And the AGI and earned income amounts became more restricted. So this year, the amount actually has risen a bit. A big, big change in the tax law this year is the energy efficient home improvement credit. The energy efficient home improvement credit was previously known as the non-business energy property credit. Now, it was extended beginning in 2023 for 10 years. And it's going to last through 12/31/32, the end of 2032. Now, credits are reported on IRS Form 5695. Part 1, page 1 of that form is out of scope for Tax-Aide. So we only deal with the credits that are on Part 2 of the 5695. So there is the front of the form. Again, that Part 1 that says Residential Clean Energy Credit, that is out of scope. So there are things like qualified battery storage technology and so forth. Those are out of scope for us. So we would do anything in Part 2. The energy efficient home improvement credit is increased for years after 2022 with an annual credit of up to $1,200. It was $500. So beginning January 1st, 2023, the amount of the credit is equal to 30% of the sum of amounts paid by the taxpayer for certain qualified expenditures, including qualified energy efficient improvements installed during the year, residential energy property expenditures during the year, and lastly, home energy audits during the year. Now, the improvement this year for total cost is 30% versus 10% in 2022. Again, it's cumulative. It's a max of $1,200 per year. So there's no more maximum lifetime limit. In years past, it required us to go back to potentially to 2005 to see where a taxpayer stood in terms of reaching what was the $500 max. So it now includes installation costs, which weren't included last year either. So it includes exterior doors, limited to $250 annually, exterior windows and skylights, limited to $600 annually, insulation, limited by annual aggregated max of $1,200. It's basically saying if you have multiple installation projects in a year, insulation projects, you can add them together and max out the $1,200. Energy efficient air conditioners, water heaters, furnaces, and boilers are limited to $600 for each item annually. And again, home energy audits are limited to $150 annually. So taxpayers can now put all those things together and max out $1,200 each year. So it's much, much better credit this year. Now, that $1,200 yearly is the credit maximum for all what they call building envelope components, home energy audits, and energy property. Electric or natural gas, heat pump water heaters, electric or natural gas heat pumps, and biomass stoves and biomass boilers have a separate aggregate yearly credit limit of $2,000. So the maximum total yearly energy efficient home improvement credit amount could be the $1,200 plus the $2,000. It could be $3,200 in a year. A couple of qualifications. It's available for certain improvements made to primary and second homes. The credit's not available for improvements made to homes not used as a residence by the taxpayer. They don't live in them. They can't claim this. The credit's only for qualifying expenses incurred for an existing home or an addition or renovation to an existing home. It's not for a newly constructed house. And if the taxpayer uses the property solely for business purposes, the property doesn't qualify for the credit. Business use less than 20% qualifies for the full credit. Business use more than 20%, you have to calculate the credit by allocating the expenses for non-business purposes. Again, that's quite a change where the maximum total credit per year could be $3,200 versus what used to be a lifetime total of $500. This is the last of the major tax changes for 2023, at least of those we had on the list when we started this presentation. Business meals and Schedule C. Business meal deduction for self-employed has been changed to 50% deductible for 2023. It was 100% in 2022. Now the qualifications are, must be provided by a restaurant. Takeout and delivery qualify. By the way, definitionally, restaurants are businesses that prepare and sell food or beverage to retail customers for immediate consumption, regardless of whether consumed on the premises. Again, takeout and delivery do qualify. And the meals can't be lavish or extravagant, and the taxpayer must be present. The one thing is with meals is no entertainment can be included in the price of a meal. This is just a little handy chart I found for 2023 in terms of business meals and Schedule C, showing the type of expense and the deduction associated with that. Is that we just talked about business meals with clients, 50% deduction. I am amused that food for company holiday parties is 100%, but we had discussed the other day snacks and things for yourself, your family, what have you. You're driving around. I think we had a delivery driver we use as an example, and you can see at the bottom that deduction is 0%. We've now covered the major tax changes for 2023, and I'm going to go pretty quickly through some miscellaneous ones, some others. We'll start with the qualifying relative gross income test. The threshold amount was raised in 2023 to $4,700. Again, it's used for the qualifying relative gross income test. The personal or dependent exemption deduction may recollect when they changed the standard deduction a few years back, increased it dramatically, they changed to 0, the personal or dependent exemption, and that will stay in place through 2025. HSA contribution limits. Family plan went from $7,300 in 2022 to $7,750 in 2023. Self-only plan increased from $3,650 in 2022 to $3,850. And it's still the same. Add $1,000 if the owner is age 55 or over at the end of the year. There's no change from 2022 to 2023. All right, get some great miscellaneous changes here for 2023. The Social Security tax limit. So there's a limit on how much of a person's income is subject to Social Security tax. For 2023, the maximum earnings subject to Social Security payroll tax increased from $160,200 up from $147,000 in 2022. So this means the maximum Social Security tax that can be withheld from a paycheck in 2023 will be $9,932. Fringe benefits. The monthly limit for tax-free qualified transportation and parking fringe benefits increased to $300. Now that's up from $280 in 2022. My favorite of all is the gift tax exclusion. So the annual gift tax exclusion increased to $17,000 that you can give to an individual, each individual for 2023, up from $16,222. So you can give someone up to that amount without filing a gift tax return, having to file it. The lifetime exclusion also increased to $12.92 million. That's going to dramatically affect me. Qualified adoption expenses. The maximum credit for adoption expenses increased to $15,950. That's up from $14,890 in 2022. And the foreign earned income exclusion. I know a lot of people, when I worked in the government, were overseas. For 2023, the foreign earned income exclusion is $120,000, up from $112,000 in 2022. Again, if someone qualifies, they can exclude the foreign earnings from their income up to that amount. So public safety officer insurance exclusion. They can exclude up to $3,000 in insurance premiums. The change isn't an amount. The change is that it no longer requires the plan to directly pay the insurance premiums. Here are the mileage rates for 2023. Business miles, 65.5 cents. Medical miles, 22 cents. Moving miles for active duty military is 22 cents. And charitable miles, 14 cents. Forgiveness of student debt. This was put in place to run from 2021 to 2025, so it's good for 5 years. It's exclusion from gross income for student debt forgiven. So this is either through the educational institution or through the lender, and if made, insured, or guaranteed by the U.S. or an agency thereof, U.S. government or an agency of it, a state, territory, possession, or the District of Columbia, or any political subdivision thereof, or an eligible educational institution as defined for the American Opportunities Tax Credit. And it can be any private education loan or by an educational organization. Now that's unless it's granted in exchange for services provided. Okay, 2023 due dates. So the 2023 tax return due date is Monday, April 15th, 2024, except in Maine and Massachusetts. For us, it's going to be Wednesday, April 17th, 2024. Now, the tax year 2023 estimated payments, when people should have submitted their 1040 payments by, estimated payments, they were due April 15th, June 15th, September 15th, and coming up, January 16th, 2024. So I get asked quite often, what's the minimum requirement filing a return? And so I have this chart I wanted to put up. I'm not going to spend much time on it. So if you're under 65, you probably have to file a tax return if your 2023 gross income was at least $13,850 as a single filer. If you use another filing status or you're over 65, here's how much you have to make to file taxes this year, or you should. One of the most amazing facts that stuck with me was a requirement to file for married filing separately and earning at least $5. Now, it didn't provide any changes for TaxSlayer. I apologize. There is a video on the Practice Lab. If you go to Practice Lab, on the bottom of the Practice Lab page, over to the right, you can see at the very bottom, there's a recorded webinar on software enhancements. I actually watched that last week. On there, they actually talked about federal tax changes for the year, and the gentleman who presented it said, basically, we're not spending much time on it because there weren't many changes to the federal tax law. But Again, for tax slayer changes, you can go out and view that video when you have time. So those are the changes for the year, the major changes and some others. Will there be more to come? You never know. We could see some more changes. Happens every so often. So there could be more. Stand by. Well, that's the end of the presentation. I'm going to pause now for questions and comments.